All right, everyone, welcome to this week's show. My name is Ali Mona, and I am a health strategist and an online business coach. And every week, my aim is to bring you live interviews with experts like Steph here that span various fields in health and wellness. And my goal is to empower you to find more freedom and possibility in your life. And so, if you've been following along for Financial Literacy Month, we've done 3 episodes already with Stephanie. The first one was talking about budgeting, the importance of budgeting and how to do it effectively. Second, we talked about debt repayment. I'm trying to recall debt repayment. And then last week we talked about mindset. Is that the order we did it in?
Yep.
Okay. And today's the big one about investing. So what do you do with your extra once you've gotten your budget taken care of, once you've paid off the big debt? What do you do now, right? Like what strategically can you do to grow your assets, right? To grow your bottom line. So Steph, welcome back. I'm super excited for this show.
Thank you. Thanks for having me back. It's been a fun series.
Yeah. We've done a little bit of investing, but I'm every show that I've done with you, I've learned something new. So I'm super excited. Where do we start when it comes to investing?
Yeah, I think this is such an important topic. It's what a lot of people are like want to get into and start paying attention to their money for because they're like, I want to invest. How do I invest? And then you get into it and realize there's some work to do first, right?
Mhm.
There's the budgeting, there's the paying off high interest debt. And you said, what do we do with the extra that we have when, all that's taken care of? There's a flip side to that, though. You could also say, I'm worried about retirement and I need X amount of dollars, right? More toward retirement a month. Then you go back and reverse engineer your budget and say, what areas can I cut out? Where can I sacrifice in the short term so that I can create that $500 a month that I want to be putting toward my investment, right? So it's not
Right.
just what we have left over. It's also that concept of like paying yourself first, paying your goals first, and then living off the rest, like figuring out how to live within what you have after that, rather than taking care of all the bills and wants and needs and extras, and then using the scraps that are left over to invest. So you can do it both ways, right? But if you're not saving or investing, you probably need to do the way I just talked about. Figuring out how much you need, how much you want for your goals, and we'll get into that a little bit later. And then reverse engineering your day-to-day budget to fit that in.
Right. And it's a form of self-care, isn't it? It's like just like we talk about in general health topics, financial self-care is equally as important because you have that long-term view for your future and where you want to be to live comfortably in that last bit of your life, really.
Yeah. And it is based on your goals, right? Your life goals, not just financial goals. Like, what do you want to be doing with your life? How do you want to be spending your time, right? Like you said before, all of life and wellness and stress is tied into financial goals. And I find when women have a plan for their money, when they're investing, when they know that they're saving X amount toward their future, like it just changes how you show up in the world. So that's why it's related to personal health and wellness. So
Yeah.
yeah, before we begin on investing, though, I just want to start with a disclaimer that I'm not a financial advisor. I'm not a financial planner. I don't hold any securities licenses. I don't sell financial products. But I am all about empowering people to educate themselves around their money, which includes investing. So this is for informational purposes only,
Yes.
and specific advice, like please talk to a CFP. Also, some parts of this may only be specific to those living in the United States or those with United States bank accounts and retirement accounts. But a lot of it will be relevant to anyone and everyone. Just the basic, building blocks of investing.
Right.
And a lot of women are intimidated by investing or the thought of investing. And there's a good reason for that. It wasn't a field that was built for women or with women in mind. And we've been, historically, systemically excluded from it for a really long time. It wasn't even until 1974 that women could get credit cards with their own name, without the signature of a spouse. So
That's
we've
only
been,
50 years ago.
yeah,
50 years ago.
yep. And I should
Okay.
know this. I don't know the exact year too, where like a woman could get a mortgage in her own name by herself. I mean, it's wild. So, there's a reason that a lot of women feel intimidated by investing. And I want to get that out of the way. Like going back to our mindset talk from last week, it doesn't have to be intimidating if you don't tell yourself it is, right?
Mm.
So if you think like, oh, I'm not going to get this, investing is intimidating, like you're probably going to shy away from it and not do it, right? But if you start to change those thoughts, right? Okay, how do I want to feel, and what would I need to think to feel this way? Well, I want to feel empowered. I want to feel confident. I want to feel productive or like I'm making progress. So what do I need to think? Thinking about those thoughts that say, I can learn what I need to know. Like there's plenty of women out there right now that want to teach other women about investing, that want to help. Like those thoughts are going to make you be more likely to actually get out there and invest, right? When you're thinking, I can do this and I can learn what I need to know and I can learn as I go and all of that.
Mhm. Yep.
That's how the mindset ties into everything, right? And unfortunately, I can't talk about investing without using some jargon. And so it's really important to like at least learn some of it, right? It's kind of like learning another language. Every, field has its own nuances there, right? If I started talking about like anatomy and physiology, right? Like that's if you're looking at injuries and whatnot, you can use jargon there to be like, oh, that's a sprain and you should do proprioception, right? Like that's just as confusing as like, oh, ETFs, mutual funds, whatever, right? You have to just take the time in whatever field you're trying to understand to like learn, the nuances and the verbiage. So
Yeah, and
I
I
will
think the
try to
mindset here of
simplify it.
this is learnable,
Yeah.
right? Like you're smart enough to learn this. It might take time and you might have to read some books. Steph's got some great resources to share. But you can learn it if it's important to you.
Yeah. Yeah. So, going like back to women investing less and later, like let's have some facts like form the foundation of our mindset too, right? Studies do show women have less because they invest less and they invest later than men. You go and add in the gender pay gap, and those factors are just another, conglomerate in the gender wealth gap. Which is even a bigger problem and like the driving fire behind why I do what I do. So for those, just quick recap, the gender pay gap is that women make 84 cents to the man's dollar, less for women of color.
Hmm.
And that's a big problem. But the gender wealth gap is an even bigger problem. And that's a little bit lesser known, but that is not how much women make compared to men, but how much they actually own and keep. So how much they have, the value of their assets, including cash, investments, real estate, minus your debts. And the gender wealth gap, basically the most commonly referenced reports say that for every dollar a white man owns, so assets, real estate, cash, investments, that kind of stuff, for every dollar, women overall own just 32 cents comparatively. And Black and Latino women is about 1 penny, 1 cent they actually own in their own name compared to the white man's dollar. So big problem,
Yeah.
big problem. And studies, however, show that we are actually better investors than men. We have better returns over time, and female
Mm.
investors outperform their male counterparts. So the women investing later and less than men isn't using facts to back up like why they should be doing that, right? Like we're actually better at it. There's a lot of reasons for that. Some of them are that we don't jump in and out of the market like men do. Like it's a long-term
Mm.
game and we're more patient, and then are like, oh, there's a downturn, let me pull all my stuff out, right? And then they lose out on the gains that come later. So additionally, like women owned businesses are growing twice as fast as the national average, yet women owned businesses receive only 16% of the like conventional business loans, which is
Yeah.
crap. And it's even worse for like women founded startups and venture capital funding.
Hmm.
That's a whole nother, like women, like less than 2% of the venture capital funding, and the women and people of color is like less than 1%. So those are just like some of the things that fire me up and get under my skin about investing. Business owners, women also pay higher interest on loans, like on business loans, 0.5% higher interest on credit cards. They pay higher percentage, higher interest on personal loans and mortgages than men do.
Wow.
Yeah. So if those stats don't piss you off, then maybe you're a man. But that's a whole other discussion. So long story short, like let's get and keep more money in the hands of women.
Mhm.
Right.
Well, and
Like
I mean, equally, right? It's not like we want to take all the money from men, but let's get some a little bit of equality here so
it's
that we
not pie.
can,
Yeah.
yeah, right?
It's not pie. A
Yeah.
woman owned business being successful isn't making a male owned business any less successful. But all those factors like play into why women invest less. They're making less, they're spending more on childcare, they're spending more on their families, they're giving back more into their communities, all of that stuff. But how do we like get equal power? How do we have more influence? Getting and keeping more money in the hands of women, and investing is, huge, huge, huge building block for that. So
Yep.
in terms of where you start, before you invest, again, and we kind of went through these too as the building blocks for leading up to this. Have you mastered your cash flow? Do you know actually what comes in and out every month? Do you know what you have to work with? Do you know where your money's going? Have you saved at least 3 months of expenses in a high yield savings account? I'm definitely a proponent of like saving and investing at the same time, but we should, not be investing if you only have $1,000, starter emergency fund.
Emergency fund, right?
Let's get that up to at least 3 months and then, talk about the other investments. Are you saving for your short-term goals, right? Are you taking a trip next year and you need to put a deposit down at the end of this year and like you need to put $1,000 a month away for it? Have you started doing that, right? Or
Mhm.
$100 away a month? So some of that kind of stuff, are you saving for medical costs? Are you saving for the vet bills that you're going to have when you get a new pet? Those kind of things. Do you have little savings buckets for kids' birthdays and holiday gifts and home repairs and whatnot, right? Let's have those pieces in place too, because if you don't, like those things are going to come up anyway. And where's the money going to go or come from for them?
Right.
Um, and then have you paid off high interest debt? It doesn't make sense. The stock market has returned an average of 10%, over the last like 100 years. Every 2-year period, there hasn't been a time where the stock market like hasn't come back, had a positive gain, right? So it's returning a decent amount over, every 10 years. But if you're paying 29% on a credit card, right? The math doesn't make sense.
Right.
Personally, and there's debates over this, but personally, I feel like if you, have $25,000 on credit card debt at 30% interest, and you want to put $500 a month toward an investment that's going to earn 10%, you're going to pay way more in interest and keep yourself in debt a lot longer. But
Right.
things like student loans or automobile loans or your mortgage, right, that hopefully are in the like 2 to 5% range, by all means, we can absolutely invest and still pay off student loans.
Mhm.
So those are kind of like, where do we start, right? Things we really want in place before you're truly ready to throw money towards, the stock market, towards investments, that kind of thing.
Okay. Awesome. That makes sense. And that again, we're building upon that's why we did a 4-part series. We didn't start with investment because you kind of have to have your ducks in a row
Yep.
before you make some investment decisions.
Yeah. So the secret sauce behind investing is time and compound interest, right? So that's one jargon is compound interest. And in the most simplest definition, it means you're earning interest on your interest, right? So the sooner you start investing, the longer your money has to grow and the more compound interest will do its magic. So the simple example of compound interest is, say you start with $1,000 and you're getting a 10% return. In 1 year, you'll have earned $100, right? So you'll have $1,100. So then the next year, you're earning interest on $1,100, not just the initial 1,000, right? So then a year after that, 10% is $110 instead of just $100, right? And so on. So then after that, you're earning interest on $210 extra, as well as your, initial deposit. So it just grows exponentially if you look at the graph. Oh my gosh, graph. Another conversation. Back in the medical mind yeah.
Yes.
Look at the graph. So yeah, it just grows exponentially, compound interest. So that's pretty much what you need to know about compound interest. Time and is the secret sauce behind that. So, to start investing, again, there's some building blocks. We want to educate yourself. Some great books that I can recommend on that are Girls That Invest by Simran Kaur, I think it's pronounced. I probably botched that, so I'm sorry. Simrankaur is her name. And Broke Millennial Takes on Investing by Erin Lowry. I think those are two great books. Erin Lowry breaks it down into very, very simple pieces, much better than I'm going to today. But my best piece of advice is never invest in something you don't understand.
Right.
So if you don't understand it, why are you investing in it? Because your friend told you so? Let's take some time, educate yourself, know what you're investing in. Then you need to decide, how much. How much am I going to invest a month? And this comes back again to knowing your cash flow, right? Knowing how much you can invest, knowing your bills, your needs, your wants, your short-term savings, that your emergency fund, holiday gifts, home maintenance, trips, that kind of stuff is
Right.
covered.
Okay.
Lots of questions.
No, makes sense so far. Keep going. Because I
Cool.
know we got some meat. So let's
Yes.
keep going.
Yep. Okay. The next thing, you want to understand the fees. So there's a lot of hidden fees in investing. And some of these examples are your brokerage or financial advisor fees. A brokerage is simply like the company that makes the transactions for you, moves the money, buys the things in the market, sells them. That's what a broker or brokerage is. So they have fees. Financial advisors and planners have fees. There's something called expense ratios and trading fees. So first I'll address like financial advisor, financial planner fees. It's really common to hear like, oh, 1% fee. And that might seem like a small, price to pay for investment guidance with financial planning, but it can significantly like erode your portfolio and your returns over long term. 1% of $1,000 investment, that's $1. People are like, okay, that's fine. I'll pay this person $1. However, if we get larger and think larger, like it really makes a difference. So let's say you have $2 million to invest and you're getting 7%, returns over 10 years. That's a highly likely scenario in the stock market. 7% annual return over 10 years. So with a 1% fee in that 10-year period of time, your investment would grow from $2 million to $3,558,112, which is great. That's awesome, right? You're up $1.5 million. But you would have paid $376,000 in fees, basically.
Right. At a 1%, right?
Yeah, at a 1% rate. That's like $37,000 a year that your financial planner is getting out of a 1% fee, right? So that can add up immensely. With a 0.5% fee, your investment would grow to just over 3.74 million. And you would have paid 192,000 in fees. So you can see that fees really make a difference over time. And there's a lot of people that think like the percentage-based fees don't actually make sense, right? If you have $1 million to invest and you have $4 million to invest, and those people are both paying a 1% fee, the person with $4 million have paid like 4 times more in fees, right? But are they getting 4 times more time, energy, effort, knowledge,
Value.
service,
Right.
value from that financial advisor. No, that financial advisor is using the algorithms, using, the customer's needs, wants, goals in mind to like probably spend about the same time planning for that person, right? So we'll get into that a little later when like choosing a financial advisor, but basically like the fee only model, I'm very much in support of, where it's like you paid $7,000 a year, like flat fee, or $10,000 a year flat fee to them, which is, much lower than $19,000 a year for a 5% fee on $2 million. So,
Right.
so that's one area of fees. You're also paying an expense ratio fee. So what your money is invested in, like stocks, ETFs, mutual funds, all of that, all of those funds have what's called an expense ratio fee. And that's basically the fee for the company to manage that mutual fund. So like your financial advisor isn't the one managing that mutual fund. They're just telling you, I think this is a good mutual fund to have your stuff in. But the company, the holder, the brokerage is actually like managing the mutual fund and deciding what goes in and out of there. They need to get paid too, right? So the expense ratio is basically like what you're paying in order to own that fund. So a lot of them are like 0.3 to 0.7%, which is fine. There's an ETF I really love. It's called the Addisina Social Justice ETF, and their expense ratio is a little higher than maybe like a Vanguard one, because they are very vocal about paying their people like livable wages and providing paid leave and hiring minorities in the LGBTQ community, right? So something like that in terms of investing along with your values, like I'm happy to pay, 0.75 or 0.8% expense ratio on that fund specifically.
Because it aligns with your values.
Yep. So, but some of those expense ratios can be like 4 or 5%, right? Those funds better be earning you a heck of a lot of returns, right? To validate a 4 or 5% expense ratio fee. So those fees can also add up. And then there can be fees for anytime something is traded for you. Anytime something's bought or sold, there can be a transaction fee for that too. So understand where the fees are coming from, how the people involved are getting paid based on those fees is a huge piece of understanding the investing world, right?
Yeah.
Because if you think, oh, I have a great financial advisor with a 1% fee, like, are you really looking at how much that means? Does that it translate to $37,000 a year that you're paying that person to manage your assets? And then, do your research. So places like Morningstar, Investopedia, Smart Asset, and Market Watch are all really great websites to get information from on pretty much any investment related question, on any fund, on any like investing company, all of the things. I highly recommend those places to do your research.
We'll put those in the show notes.
Yeah. So now, you know where your cash is going. You know how much you want to invest. You understand the fees. You've done some research. You also want to ask yourself, like, what's my goal?
Yeah.
What is my goal out of these investments? What are my short-term goals? The next month to 3 years. My medium-term goals, 4 to 10 years or so, and a long-term goals, 10 years and over. There's some debate around this, but in general, I would say the experts recommend any goal over 5 years out, like, is a good goal to have in the stock market. If you want to buy a house in a year and you put your down payment fund into the market, like, it might take a downturn. You might lose half your money in 1 year, right? In
Right.
5 years, it's more likely to have evened out, bounced back, and have those positive returns. But year over year, like 6 months to a year, you might have terrible returns.
Right.
So, and some people would argue that, some people put their emergency fund in the market. That's not how I coach. That's not where I stand. Emergency funds, I think, should be in high yield savings accounts.
And
But yeah,
accessible.
yeah. And, you shouldn't have to pay, capital gains taxes on like getting money out for an emergency. But that's just my perspective. There is some debate around that. But short-term goals, medium-term, long-term, right? What's the goal and where's it going to go? And then you want to figure out which type of account you want to use, right? So some examples of investment accounts are the common ones: 401ks, IRAs, 403bs, SEP or simple IRAs, which are used for small business owners, and brokerage accounts. And then you want to understand like Roth versus traditional. A lot of people don't think of themselves as investors, and then you ask them, like, do you have a 401k, through your business, or, through your employer, or do you have an IRA? If you have an IRA and you have a 401k, like, you are an investor, you are invested. So flip your mindset on that too. If you have a 401k,
Right.
you have an IRA, like, you're an investor. Congratulations, you're already doing it.
Mm-hmm.
But understanding like Roth versus traditional. So a lot more places now are offering Roth 401ks as well, which is pretty cool. But Roth versus traditional can be a traditional 401k, traditional IRA. That is paid with pre-tax income, right? So you get your income, and then they take out the Medicare, Social Security, and then your 401k contribution, and then they tax you on what's left, right? So your traditional is paid with pre-tax income, and then it's deductible on that year's taxes. So you get a tax break now, essentially. Both traditional and Roth IRAs for 2024 have a max contribution limit of $7,000. If you're under 50, if you're over 50, it's 8,000. For 401ks, they have a max contribution limit for 2024 of $23,000, or $30,500 if you're over 50. So for traditional IRAs, you can withdraw contributions at any time. Like, the money you put into it, you can take back out of it. But you cannot start withdrawing earnings, like the interest grown on it, before 59 and a half. And if you do withdraw earnings before 59 and a half, you're subject to a 10% penalty plus whatever your income tax level is. And then on traditional, you're also required to take minimum required distributions, or RMDs, at 73. So you have money sitting there, you want to keep it sitting in there, like after 73, the government forces you to take a minimum distribution, like monthly, quarterly, or yearly, out of your traditional IRA. And then also there's some income limits where, like, you can't take the tax deduction if you make over a certain amount. And then you pay, standard income tax when you withdraw that money in retirement. Roths, so Roth IRAs and 401ks, are paid to the investment account with post-tax income. So you get your income, they take out, Medicare, Social Security, your healthcare, whatnot, then they tax you, and then they contribute to that 401k or IRA. So it's not tax deductible now, but you get a potential tax break later, because you're not paying taxes when you take it out. So you can't withdraw before 59 and a half, unless it's part of a qualified withdrawal. So there are some things like first-time home buyers can withdraw money from a Roth IRA without the penalty. The Roth IRA is not subject to required minimum distributions. So if you want to keep that money there, maybe pass it on, a Roth IRA lets you keep it there even after 73. It doesn't force you to take distributions. The government basically, like, wants their taxes out of your money, right? So they're like, at 73, you didn't pay taxes on this for however many years. Now we need to get our piece of it back. But since with Roths, you've already paid the taxes on it, they don't care if you
I don't care.
have to. Yeah. So, but it does have income limits. If you make over a certain amount, you don't qualify to contribute to a Roth. Except like a backdoor Roth IRA, which is more like an investing 201 course. So we won't go over that in this, but with Roths, your earnings grow tax-free and withdrawals are tax-free. So you don't pay
So
taxes
is
on it.
there a better option? Like, should someone start with one or the other?
Yeah, that's a great question. It depends is the answer. Much like everything in financial world, it depends. Roths can be a great option if you think that the money you're making now, you're gonna take out more money in retirement than what you're making now, basically, based on your monthly income. So if you're not making that much now and you're in a lower tax bracket now, pay the taxes, you can pay the taxes on your stuff now with the hope that you have more in retirement than you're going to pay yourself more in retirement than you're making now because you're saving so much now, that you would be put in a higher tax bracket in retirement, if that makes sense.
Yep.
For traditional IRAs, you could, if you think you're in a higher tax bracket now, then you're going to be in retirement, right? You're going to live on less in retirement than you're making right now. And you might be in a lower tax bracket in retirement, then it would make sense to do a traditional.
Pay the tax now.
Yeah. Or, a mix, right? There's,
Mm.
I like the saying like match beats Roth, because if your company has a match, and you don't contribute up to the match of that, you're throwing free money out the window every single month. So a lot of people, if you have a 6% match, you contribute 6%, so you get that match, and then go contribute the 4% to a Roth IRA. So you're kind of evening out, diversifying your assets, which just means that it's invested in different places, into different things, over across a variety of financial avenues. You don't want all your eggs in one basket. So that's
Right.
really all diversification means. So yeah, it depends. And a lot of people do both, right? So there is a saying, match beats Roth, Roth beats traditional. But it depends, again, on your income level, on your expected retirement date, on your expected income in retirement.
This is where you talk to somebody and get a plan.
Yep, exactly. They can run
Yeah.
the numbers for you and give you good advice. So
Yeah.
again, this is just for educational purposes.
Well, right. And it's, before you hire someone, here's my philosophy as an entrepreneur. Before I hire somebody, I still do all the due diligence, because how do you know if what they're saying is right? How do you know if what they're saying aligns with your goals and your aspirations? Right. So it's still valuable to learn it yourself, even if you're going to be hiring somebody, or at least hiring an advisor.
Yep. Exactly. Because that advisor might be biased toward the company they work for, the culture, the company they work for, the products they sell. I
Right.
mean, I know people here that literally hate the stock market and say 401ks are a sham and only wants to sell people whole life insurance. Well, that person has really good intentions for what they think is the best way to do something, right? But you need to kind of know for yourself what you think about all these things. So that's where places like Investopedia, NerdWallet, Smart Asset, Market Watch are great places to get. Yeah, like you said, do the due diligence ahead of time, so you're more educated and more confident going into those conversations, right?
Yeah.
So, then you need to figure out okay, which type of securities do you want? And I think I might have mentioned that term before, but securities is just a fancy name for what your money is invested in. So mutual funds, ETFs, which stands for exchange traded funds, REITs, which is a real estate investment trust, bonds, cryptocurrency, those are all securities, right? It's just a fancy name for the bucket, the type of bucket that your money is in.
Yep.
And one common mistake people make is they open an IRA and transfer money, and then it just sits there. You actually have to invest it in something. And by invest, I mean buy the things, buy the mutual funds, buy the stocks. Yeah, a lot of people just think if they open an IRA and transfer money, then it's invested. But double check, right? Depends on who you use. If you're doing it by yourself and you haven't selected this type of fund, or the one recommended by the bank, or by the company you're going through, a lot of them will have recommendations, but you actually have to make sure it's invested,
Or else it just sits there. Yeah.
yeah. sits there in cash. You know, so then we want to talk about like, okay, do I want this done for me or do I want to manage it myself? You know, do I want to use a human or a robo-advisor? And robo-advisor is a fun new term that basically just means AI and algorithms have been used to like inform the bots, the computers out there to like what to do with your money, right? But they're based on research, they're based on historical evidence, right? They're based on data and the best, you know, knowledge or recommendations out there. So if you want to use a human, I highly, highly recommend getting a CFP, a certified financial planner. They have taken extra courses, they have taken extra exams, and they're held to higher standards. So
As opposed to what?
like a financial professional, like someone that just calls
Got
themselves
it.
a financial professional. There are a lot of financial professionals out there who are not financial advisors. They're not licensed in like securities. They may be licensed in life and health insurance, but not like trading
Yep.
essentially. And they just represent themselves as, oh, I'm a financial professional. No one asks the questions. And they're like just pushing whole life insurance policies on people as like an investment that will save your life or save you. Like, oh, this is, you know, borrow from your, that could be a whole nother series
Yes.
alone about life insurance and whole life policies as an investment versus like the market. But yeah, do your due diligence on who you're talking to.
Yep.
You know, the other thing is make sure they're a fiduciary. So here's another fancy term: fiduciary duty versus the suitability standard. So CFPs are held to a fiduciary standard. Like literally it's regulated. They have a fiduciary duty is basically requires an advisor to act in the best interest of their clients. Suitability standards mean they just have to do something that is suitable for you or recommend a product that's suitable for you, you know, but it could also benefit them. You know,
Right.
if I sell this life insurance policy, I'm going to sell you this one because I get a 20% cut instead of the one where I get a 10% cut, right? Both might be suitable for you, but it might not be the best one. So yeah, a fiduciary just means it's like investment advisors who work directly with clients and they're bound by that standard.
Yeah.
It's
Well, you're more
regulated by
protected, right? Like as an investor, you're more protected because they have to look after your best interests alone.
your best interest,
Yeah.
regardless of how it affects them. So that's
Mhm.
regulated by the Securities and Exchange Commission or the SEC. And again, the client's interest comes first. The fiduciaries have to prioritize the client's interest above their own. So that duty, you know, it encompasses the duty of loyalty and care, and yeah, and it's regulated. So suitability standard is like a brokers or people who work for a broker dealer follow the suitability standard.
Got it.
They must believe that their recommendations are suitable for the client, but the focus is on like transactions that meet the client's needs. It doesn't necessarily prioritize their best interest. So
Huge difference.
yep, the brokers serve the interests of the broker dealer they work for, right? So if they are going to get you an insurance policy or sell you a mutual fund or whatever, they're probably selling you the one that's going to benefit their company the most. And it could be suitable for you, but it might not be in your best interest. So all CFPs have to be a fiduciary. Not all fiduciaries are CFPs though. There's other levels of like financial licenses and certifications that people get and hold themselves to a fiduciary standard. But you always want to ask, you know, are you a fiduciary?
Got it.
And if they're not, you know, buyer beware, I guess.
Yep.
So, you know, then, okay, again, so that is my soapbox on, you know, if you want a human to do it. And again, but that goes back to fees. You know, there's tons of articles out there you can research, like what questions to ask when interviewing financial advisors. Interview like 3 to 5 of them. See who fits the most, who's in alignment with your goals, who, you know, is not bound by a captive agent, meaning they can't only sell products of that company. And do your, you know, see who's a good fit, do your research, ask questions, come with a list of questions. and find out how they get paid. How are they getting paid based on your investments? So robo-advisors are, again, automated investment platforms like equipped with AI algorithms to manage your portfolio. And your portfolio just means like what all your money is invested in. And they use that based on like your investor preferences, like your risk tolerance, your age, your financial goals, and they're really great for like all types of investors. Even if you want to be really involved and active and pick your different funds and whatnot, like robo advisors are great ways to do that. They're pretty flexible. They have the best ones have very low fees, like large options of portfolios that you can pick from, flexible account types, like you can get a hold of them easily. You don't get a one-on-one advisor relationship, but like generally they have a pretty decent customer service department. And you can
So
invest.
what do you count as a low fee, Steph, for a robo advisor?
For a robo advisor, it depends. And it's been a while since I did the research into robo advising fees, but I get like 0.25%.
Got it.
I think was like Wealthfront and Betterment the last time I checked, maybe 0.3%. And their fees are going to different things, right? They're going different things than just the one person that's actively managing your stuff, right? And you can invest in totally various assets like mutual funds, index funds, crypto, right? Like they have a lot of options. And some examples of those kinds of companies are Wealthfront, Betterment, Ally has robo portfolios, SoFi does, Schwab Intelligent Portfolios, M1 Finance, Wealthsimple, and Ellevest. I personally have my Roth IRA through Ellevest. They are a woman-founded, woman-owned, woman-run company. They are amazing. They, have more than 50% of their board and executive level C-suite people are minorities and women. All of their financial planners are women. Like it's pretty amazing. So Ellevest is a great one. So yeah, look into the platform, right? Again, NerdWallet, MarketWatch, Smart Asset has lists like comparing all of these companies,
Yeah.
finding their minimums. Some of them have a minimum amount of money that you have to invest in order to open an account there, right? Some places like a $25,000 minimum. Okay, probably not going to go there right away, right? Ellevest is like $100, right? A lot of them minimum is gonna be $100. You can start with as little as $100. So
Is
again,
Vanguard considered a robo investor?
so a lot of these companies have both, like Fidelity Go, Schwab Intelligent Portfolios. They also have financial planning services, and Vanguard is one of them. But they also have branched into the robo advising as well, right? So you could get your financial like planner through Vanguard or Fidelity or Schwab. You could also do a robo portfolio through Vanguard or Fidelity or same with Ellevest. And Vanguard, and don't come at me, people, if like you have everything in Vanguard and love Vanguard. But when I was talking a long time ago with somebody who I respected as a social impact investment manager, there's something called ESG investing or impact investing, where you're choosing funds and you're choosing things to invest in that are tobacco free or big oil free or live up to certain standards about the environment and the environmental impact of their company, and have certain levels of standards for their governance of minorities and women and whatnot. That could be a whole nother series too. But I was talking to a financial planner that worked for a impact investing company, and her line, I'll never forget this, is she said that Vanguard is like the Walmart of investment companies. Their expense ratios are the lowest. And if we think back to the Adesina conversation, like they're paying their people lower percentages to manage those funds. So I personally don't use Vanguard because that line will stay with me in my head forever. And I don't shop at Walmart for some of the same reasons.
Well, that's the cool thing
Yes.
about this world is you get to invest in alignment with your priorities and your values.
Yep.
Still.
Yeah. Your dollar, vote with your dollar, right? Support women-owned companies. and again, how much monthly, like, right? So now that we've picked what we kind of wanted in, we've done our research, we've picked the company, like, again, back to how much monthly. And I would say it is better to do monthly investments, even if it's $50 a month, $100 a month, than like a lump sum with your tax return or whatever at the end of the year, or your bonus. This is like investing 201 again, but it's something called dollar cost averaging.
Mm,
Which just know it's better to do it consistently throughout the year than like a big lump sum at one time.
right.
But the best thing to do is just get started. Like, get started. If you have a workplace retirement plan, like, get the match, right? If you don't and you're a small business owner, like, open a Roth IRA or open a simple or a SEP IRA. Brokerage for medium-term goals. So brokerage accounts they don't have tax advantages. They're not, a 401k or an IRA. They are just like, you're just putting your money in the market into a brokerage account. You don't get any tax benefits from it, but it's a good vehicle, if you will, if you have those medium term goals where you kind of want it to be liquid. You don't want to get penalized for taking that money out. Or if you've like maxed out your 401k and your IRAs and you've maxed out like all the, tax advantaged funds, and you still have more money to put in stuff, like a brokerage account would be another place to do that. Or again, like I said, for the medium term goals where
Mm,
you don't want to be penalized for taking it out. It might not be a qualified withdrawal for a Roth IRA, right? It might not be a first house. And there's a bunch of other qualified things, but yeah, just get started, and like we were just talking about, right? You get to vote with your dollar. Use the financial power you have, right? If we go back to how to close the gender wealth gap and the gender pay gap, like it's systemic, right? And so it requires like systemic answers.
mm,
But model the equity at home, buy from women-led businesses, use women-run services, fund women entrepreneurs,
mhm.
donate to political campaigns and causes that support women. Avoid using banks or institutions that have predatory lending practices. Use your money for good. Data,
Yep.
again, data shows that women investors outperform their male counterparts. And this whole societal like myth that women aren't good investors or aren't smart enough or whatever, like it's crap. So start modeling that at home, right? By taking control of your financial education and just getting started. um
Well, and getting started could mean spending 2 or 3 months reading those books,
yeah.
right?
Yep.
Getting started doesn't mean having to choose an account today,
No.
right? Getting started means making the
Checking out
decision
the
that you are in control of your financial future and you need to fill in your knowledge gaps first. And maybe you're sitting on like a sum of money that you could invest today, but don't
Mhm.
do it if you're not confident in where you want it to be.
Yeah. Yep. Read the books, invest it. And again, that's why I bring up Ellevest, right? Like companies with more women in board and executive and senior management roles actually routinely outperform companies without gender and racial diversity. Just interested. Um, and women like reinvest a lot more of their income into their families and communities. Um, but when they do invest in the market, like they're doing it in businesses and causes that are better for the world. And that's why I say like the world is a better place when women have money. Um, but we gotta start where we are. And if it starts with $100, like, yeah, we're gonna close that gender wealth gap. One
Yep.
one woman at a time is my goal. Uh,
Yes. Well, that was a little bit of a fire hose of
yes, it was.
terminology. Um, but it just, if you're listening to this and you're like, I didn't understand much of that, like that's okay because you
Read the
haven't
books.
learned.
Yeah.
Read the books,
Yeah.
right? There's tons of financial podcasts if you'd rather listen, right? Get the audiobook. Sometimes
Listen to
it's
the
nice
books.
to,
Yeah.
yeah, listen to the books. I'm kind of old school. I like to highlight my books and write in my books and all of that. But I just want you to be encouraged that you have more potential and power than you know.
Mhm.
And it's just making that decision to say, I am going to become really good at this,
Mhm.
right? I'm not going to bury my head in the sand. I'm going to understand where my money's going. I'm going to pay back that debt systemically. I'm going to get my mindset right. I'm going to start talking to myself differently. about investing and finances. And then eventually you will have the extra,
Yeah.
right? And so even now, if you are holding debt that you need to repay, even now while you have a strategy in place to repay that debt, go ahead and start reading some of these books so that you're ready for that future time when you have that extra cash to put somewhere to put to good use, right?
Yeah.
So I hope that's my encouragement to you as you're watching this is and go back through all of the series. Yeah, and reach out to Steph for help. Like that's what she does, not the investment part, but the coaching part. But I'm sure, Stephanie, that you have people that you recommend and
Oh, absolutely. Yep.
yeah.
And that's what I love doing is helping empower you going into those conversations, right? Talking about what's important to you in a financial advisor. Talking
Mhm.
about, do you want to invest in, social impact causes or not, right? Like I can help arm you with that education and knowledge and conversations before you even go talk to somebody so that you're leading the conversation, right? You're not getting tossed around by the wind and where they want to go with the conversation. So,
That's right. And I also wrote in all of my notes, ah, everything that we don't know can feel overwhelming,
mhm.
right? If you were diagnosed with something today, it would feel overwhelming. What would you do? You would go and you would research and you would talk to people and you would fill in that knowledge gap. Same thing. This knowledge gap is fillable, right? Like you can do this. And I'm preaching to myself as well. Because I've been working on some mindset stuff too around my
Yeah,
finances, but it's fillable. And so I hope that you go and you do the work so that we can put more money and power in the hands of the people who will continue to lift this world up and do good,
yeah.
right? Um,
And that's, you can think of it, that was a great analogy, I think, diagnosed with something. The women and minorities are diagnosed with a pay gap and a wealth gap every day
mhm.
in this world. So if you think of that as the diagnosis, you're going to read the books, you're going to fill in that knowledge gap.
Yep, you are. And I want to thank you for your time, Steph. This has been super informative, and
Thank
you
you.
obviously are incredibly knowledgeable and passionate about what you do. And so I appreciate you giving so much of your time to our community.
Welcome. Thank you so much for having me for this series. And it's a fun way to end Financial Literacy Month. And let's just keep changing the world for good.
Awesome. All right, guys, reach out to Steph. I'll put all of her contact information and tag her here so that you have contact with her. And again, thank you so much. It's been amazing.
You're welcome. Good to see you. Talk
Take
soon.
care. Bye.
Bye.